Howdy, Jacob here. Today we're looking at Arcos Dorados Holdings in the hotel, restaurant, and leisure industry. 2.1 billion market cap on 2.6 billion enterprise value. They operate as a franchisee of McDonald's, so they have some exclusive rights to own, operate, and grant franchises of McDonald's in 20 countries. Pretty cool for them. Founded in 2007. All right. 4.3 billion in revenue, up slightly, maybe 2% CAGR over the last 10 years, but it looks like they had pretty consistent declines until COVID and then pretty big jumps after that. But gross margin up a bit, operating margin up a bit, return on invested capital, high single digits. Okay, so balance sheet shows about 247 million cash-like products, 31 million short-term debt, 713 long-term debt. That's 713 million long-term debt. God damn. Again, this other is their capital expenditures line. So on a 5-year average basis, not looking great. They have a lot of capex. Takes a lot to keep this business going, and they have a dividend 2%. Pays out 40 million. I mean, here we have 20 million. This one's a huge year, 230 million, 130 million, 140 million, negative, negative, negative. So 3 years in a row of free cash flow, 2 big years, and then the most recent rolling 12, you're looking at just 20 million. I mean, huge jumps in capital expenditures. A little bit looks like it's due to reinvestment, a little bit to acquisitions. So it could be that they're just investing a lot to get some good growth, but that future return isn't guaranteed. And to spend 40 million on this dividend, I don't know how I feel about that. Even on a 3-year average basis, you're probably looking at about 80 million, which compared to their 700 million debt is a good amount. And that dividend's 50% of the last 3 years free cash flow. And then again, like I said, the 3 years prior, they actually had negative free cash flow. So, I mean, let's just get to making some assumptions here. I'm not super attracted to the business from what I'm seeing from these numbers. I mean, huge growth recently. I don't know. Before COVID, they were dropping maybe 3. I don't think they deserve any sort of premium there. Margins, let's do maybe 4 and 3. Share change. Increase with stock-based compensation, 14 million. Maybe increase it 0.5% from stock-based compensation. This dividend, I don't want them to increase it. I want them to reinvest to try to get a decent return on their money, increase these margins. And from what I'm getting right here, it needs to fall pretty much in half to get to the return we're looking for. I mean, definitely didn't look like the sexiest business. It sounds like it could be. If I were to do some research on it, maybe it could be one of those sexy companies. I mean, it's a franchisee of McDonald's, so I feel like demand is there, longevity is there, but from the numbers standpoint, I just don't see it. I just don't see it as of this moment. I mean, you're looking at low teens, 13, 12% gross margin. That's a big hit from just cost of goods sold. So, yeah, that's my review. Needs to fall in half to get to maybe something I'd be more interested at. But I hope you enjoy the video. Have a great day.